Andy Dropkin is Chief Investment Officer of CD Wealth Management and currently serves as First Vice Chairman. He's also the incoming chair after I leave in September or October. He's currently the chairman of the Investment Committee and chairman of the Audit Committee of the Dallas Jewish Community Foundation. To your left is Robert Morris. He's our institutional consultant from Greystone. Greystone is the largest investment consulting firm to endowments and foundations, and yet that is only about a quarter of their entire business. So pretty substantial group, and we look forward to hearing Robert's comments about our investments. Tonight's presentation is being recorded, so going around there will be some cards and some pens for you to jot down any questions that you'd like to ask of Robert and Andy later. So now, introduce Andy.
Rusty, thank you for that very kind introduction. And thank you to all of our fund holders for being here tonight. As Rusty said, my name is Andy Dropkin, and I'm the current investment chair of the Dallas Jewish Community Foundation, as well as the next chair. So looking forward to the challenge. And again, thank you all so much for being here. Before I introduce Robert from Greystone, as Rusty said, I want to spend a few minutes discussing the Dallas Jewish Community Foundation Investment Committee and our role in working with Greystone. The committee is comprised of 10 individuals. The combined investment experience of the committee is well over 300 years in the investment business. Our job is to work closely with Greystone, our new investment consultant, to create investment policy, asset allocation, and model formation, which I'll speak about later. The committee meets quarterly to discuss market updates, asset allocation, and potential investment changes. As the Dallas Jewish Community Foundation has grown to over $220 million in assets under management, the task of being the best possible stewards to our fund holders is more important than ever. Almost 2 years ago, we decided at the foundation that it was time to hire a full-time investment consultant. We went through a very detailed search and chose Greystone. It was an easy decision. Greystone Consulting manages over $260 billion of assets, might be more now, for nonprofit, faith-based endowments and foundations. They are far and away the largest investment manager for faith-based endowments and foundations like ourselves. Our dedicated team at Greystone is comprised of 7 individuals, and we are thrilled to have Robert Morris with us tonight. Robert, along with Gary Bartok and Bill Hendricks, who some of you may have met last year at our fund holder meeting, are our dedicated team for the foundation. And as Robert can attest, we keep him busy. Tonight, Robert's going to discuss with you about the current state of the markets and where Greystone Consulting sees it heading, both short-term as well as long-term. As Rusty mentioned earlier, we ask that you hold all questions until after the presentation. Without further ado, I'll give you Robert.
Thank you very much. Thank you, Maya, Rusty, and Andy for that introduction. And thanks to everyone also for taking some time out of your very busy schedules to be with us tonight and obviously experience this wonderful exhibit. So what I'm going to be talking about tonight, I'm going to have to almost break one of the Yogi Berra tenets, which is never talk about or predict anything, especially not the future. So we're going to be touching on a little bit of that when we go through some of our discussions. So first and foremost, what we've seen and experienced this year has been kind of a volatile ride to nowhere in most of the markets. We've seen challenges on the fixed income side, we've seen equity markets, pockets of strength, pockets of corrections, and this is all coming off of the back of a very strong market experience last year. Most equity markets, depending on their flavor, global, US, large and small, have fared relatively well. So why is that? First, I need to kind of echo what's come before us since the Great Recession to talk about where we are today in the capital market cycle. So as many of you will remember, going through 2008, some very challenging times, We had a Fed, the Federal Reserve, that decided first and foremost, hang on, we need to absolutely save this system. The system is going to go off the precipice if we don't act. And that's when we had the TARP program. That was the first of the stimulus or quantitative easing moves. Then, following on from that, because the central bank said, well, there you go, there's circa 750 billion into the market, job done, let's see how that performs. And they sat and they waited. And as we've talked in the investment committee, it was almost the equivalency of you've put gasoline in your car, you've not turned it on yet, and you're sat waiting, expecting the car to go. The banks were so fearful at that time of lending, and they were also at that same time getting regulations put on top of them, that they just held pat. So then we had more stimulus measures. Remember quantitative easing 1, 2, Operation Twist, easing 3 and 4. All of this was taking place until finally the markets started to see those green shoots of recovery. But believe us, that took us from basically 2009, 2010 time window, all the way through 2015 before we really started to see any action take place there. But the other thing that had happened throughout that time window was we had grown the balance sheet of our central bank from about $800 billion all the way up to $4 trillion. It's just more money that is circulating around there. Now, one quick background lesson, and this is kind of my background is in economics. The background to that is when you have the equation is called MV equals PQ, the amount of money in the system times its velocity equals the price and quantity of goods, i.e. output, GDP, and price, inflation. So now we find ourselves in this situation where we have $4 trillion out there looking for a home. Where did it go here in the US? It went first into the bond markets, which is why we've seen bond market yields going down from the circa 5% rate we used to see on the 10-year Treasury all the way down to under 2% in a couple of instances. Now, Europe and the Bank of Japan and the People's Bank of China also saw this wonderful picture being painted in the US of, aha, here is the roadmap of how we can get out of the malaise of the Great Recession. So ergo, what do? The same thing. It's the same stimulus measures that they've gone through. Europe had a little bit of a tougher time of it because they had to actually figure out a way to print money collectively. So first and foremost, the European Central Bank had to get everybody on board with that. So they're running about 2 years behind our US schedule. So globally, to paint the full picture here, there's $14 trillion worth of additional cash that is out in the system looking for a home. So as I said, first it went into bond markets. And once bond market yields were driven down to those low levels, where does the investor look? Where else can I go for yield? Well, maybe I can look at some utility stocks or dividend-paying companies. And you see the price of those companies now bid up, up, and up. Then it looks out into the riskier form of assets, just common stocks, which is again why over the trailing year, 2017, we actually saw very robust numbers from the stock market. We had what we in the business call price to earnings multiple expansion, i.e. investors are simply no longer paying $15 to buy $1 worth of a corporate earning. They're saying, well, it's okay to pay 20 times. Or in some sectors of the market, even 30 times for those perceived safety components. So that is kind of yesterday's news. That's what brings us to this situation in the markets today. So what are we going to see going forward? Well, first and foremost, we're projecting a more tougher ride for the traditional bond market. Again, because we are at these super low yields, and what is now the Fed's concern is, oh, hang on, if I've put all of this money into the system and now people start to use it, now banks start to lend it, let's say I invested in a business of Rusty's, Rusty goes out and he hires 10 people, oh look, that multiplies through the economy, that unlocks. It's a nice virtuous cycle and it's very healthy for the economy, but it creates the specter for inflation. And that is what the central bank actually fears the most. Their dual mandate is full employment and stable prices. By the way, looking at employment, we're hitting headline multi-year lows in unemployment. So right now they're saying, check, put a pin in that, that job is done. Now let's turn our attention to making sure we have stable prices. So now there's a shift in the market as all of this giant, monetary bubble that's essentially inflated us to these higher levels, the Fed has to ease that out or else risk that high inflation. And they do so by raising interest rates and stopping any bond buying programs. Only just this last week, we heard the European Central Bank was actually stopping their bond buying programs. So again, whatever we're doing here in the US, it seems to be, we made the movie here in the US and the DVD is circulating across Europe right now. And they're pulling back too. So we see a challenge for the bond market. The stock market, however, I'm going to make a slight disconnect here between the underlying economy, which we believe is relatively healthy. Its productivity levels could be higher, but we're at full employment, and we don't think that's necessarily going to stop anytime soon. No, alarm bells necessarily ringing for a recession. But I'm going to disconnect what the stock market does, which is kind of a discounting mechanism or a mechanism for pricing companies. And what we see there is a situation where that price to earnings level had become elevated. Well, at the beginning of this year, corporate earnings have still been delivered very strong. Now, they are strong because they're off of the back of all of this good underlying economic activity. When Rusty and his successful business is up and running, all of his employees are out there able to go to Walgreens and buy groceries, they're able to go to car dealerships, buy themselves cars. All of that's very good for the underlying economic activity, and we've had good earnings. So one hopeful piece of news I'll share with everyone tonight is, while we've been at a almost 0 point this year for most equity markets, those earnings have still been delivered. And that's actually reduced the overall price level of the market. It's kind of our almost best type of market correction to have, because actually things are now starting to look cheaper and cheaper out there. And I do also want to add one very hopeful factor for the future here. I was talking about this with some of our friends earlier on, that as we look multi-year down the road, so kind of our near-term projection, by the way, would be for this year to be one of just kind of hold on, brace for some of that volatility, brace for continued volatility in both the bond and stock markets. But longer term, we're actually starting to see corporations sow the seeds for the future. We've been in a season where companies had just done share buybacks, dividend increases, all good things that a CFO would do with very low interest rates. Good CFOs, check the box there. Now, we're starting to see CapEx, business expenditure. Let's build a new plant over here. Let's build a new factory. Let's look to expand to a new market, bring out a new product line. Let's spend money on research and development. Now, it's dangerous for near-term earnings, and that's a very, shaky position for companies to be in. Heaven forbid, we are in one of this, what have you done for me lately environments. Must beat those earnings by a penny, or else companies, you see what happens when you miss. But we're in an environment now where companies are sowing the seeds for the future. And one of the things that we have not seen in this business cycle, actually, many will argue whether we have even seen a business cycle, but one of the key things that we haven't experienced yet has been productivity growth. I was just actually talking to one of our friends and fund holders earlier about the fact that it's been basically, remember the year 2000 when Office 2000 came out? What, other than maybe smartphones, has been really a productivity driver since then? There hasn't been. But now as we look to the future, some of this R&D that's taking place, we're seeing smart cars, for example. Imagine all of those sensors that are actually placed on those cars to read and understand. Understanding is another thing. Now we need processors to actually interpret that data. Oh, and we need to store that data too. Currently in the US, the most extensive data usage there is actually something along the lines of Netflix. It's video streaming that's about a gigabyte an hour. Well, to operate a smart car, it takes 20 gigabytes an hour, an order of magnitude much higher. Now also, as we look to smart factories, the whole Internet of Things capability, we're seeing a lot of this business spending is focused on companies that are, trying to gain market share by quicker deployment of their goods and services. Data security, cloud storage, all of these type of aspects are now setting the seeds for the next productivity cycle. We're even experiencing things called, I love this one, dark factories, where you can have a factory that simply runs itself, touch of a button. And it's dark because when there's no employees, you don't need to keep the lights on. So all of this technology is actually coming down the road. So near term, our message is hold on for volatility like we've experienced already. And believe us, I'm going to bring Andy back up here, and we have some pretty extensive strategies within all of the funds that are designed for protection against those moments. But then as we look longer term down the road, we're actually very optimistic about getting through into a next proper business and productivity cycle. And with that, I know we're going to be mingling around later, so there will be moments for discussion, but I'll bring Andy back up. Thank you very much.
Thanks, Robert. I don't know about you guys, but I love the accent, and I can listen to it all the time. So, yeah, it does. It just sounds so smart. He's always my first call, and I think part of it is just to hear the British accent. So, forgot to mention that in the back there are some note cards that if you want to jot down for questions. If we don't get to them tonight, we will email you answers. So, want this to be a little bit more casual, and just we can answer your questions afterwards. Well, hopefully everybody has a much clearer crystal ball. Look, we live in really interesting times, and as he mentioned, we're seeing a lot of volatility. And part of our role in the investment committee and as professionals is to reduce the noise. And when we're looking at our models and the portfolios with Greystone, we take that into consideration, and we look at our portfolios from a 7 to 10 year time horizon when we're looking to build out our models. And we have created, with Greystone, models. We have 6 models, and we've created them using a philanthropic timeline. And what I mean by that is, when do our fund holders need the money? We start from the short end. We have a stable value fund, which is just liquid cash, to a 2-year time horizon, to a 7+ time horizon. And in each fund outside, and in each model outside of the stable value, which is cash, money market, there are different holdings inside each model, some equities, some bonds. And as we move out farther, we get into what Robert mentioned earlier, some asset classes that help reduce volatility, that take a longer time horizon. Often they're more illiquid private investments, and they serve a real useful purpose when managing endowment money. With Greystone's strength, we have been able, and they have been able, to negotiate extremely low internal costs for our funds that we have inside our models. So what does that mean for you, our fund holders? It means that the models that we have are offering very competitive internal costs, which helps return, which puts more money into charities' pockets. So it is something that, as we continue to grow, and as Greystone continues to grow assets under management, the negotiation power and their negotiating power will continue to grow. We believe that our investment choices provide you, our fund holders, a great range of options and very competitive pricing. We're happy to discuss these models in more detail one-on-one to ensure that you are positioned properly in your fund. At this point in time, I don't know if we have any questions or not that are back, but if not, what we'll do is we'll mingle afterwards, and feel free to come up to Robert, Rusty, myself, and we're happy to visit further. So just want to thank y'all so much for coming. spending the evening here at this amazing museum that I've heard from so many people said, I've passed it 1,000 times, I've just never come in. So we can't thank this museum enough for having us here. Mona, thank you so much for arranging this. I hope everybody enjoyed the exhibit as much as I did, and thank you.